Hi, everyone, and welcome to our second webinar in our M&A advisory series, Quality of Earnings. Before we go ahead and get started, there are a few housekeeping items I want to go over. So just so you know, you can maximize or minimize the webinar pane during the presentation by using the red and orange arrow buttons. During the webinar, we definitely encourage you to ask questions. Our presenters will answer those questions as we go along or at the end as time allows. And then also I want to make sure everyone has good audio. So if you're using a telephone, make sure you click on the phone call audio option. And if you're listening through your computer, then go ahead and click on the computer audio option. And then just as a reminder, we are on social media, so be sure to follow us on Facebook, Twitter, Instagram, and LinkedIn. And today we have two presenters, and we have Dean Quiambo, who after spending 12 years as an auditor in our audit department here, he transitioned to our chief relationship builder for the firm. He's helped numerous private, public, and nonprofit companies address their tax, audit, outsourcing accounting needs. We also have John Dunnigan, who's a partner in the CFO advisory service practice with more than 30 years of financial operations and consulting experience with public, private companies. So with that, take it away, guys.
Awesome. Thanks so much, Marie, and we're excited to be here. Like you said, this is part 2 in our M&A webinar series. The first one was all focused about GAAP financial statements and how those were used. Today will be quality of earnings. You can see that in about a month, we'll be talking about the importance of completeness of tax accruals in the M&A process. We'll also go through equity and valuation as well. So we're excited for today. Today we have John Dunnigan, a partner in our CFO advisory group, here to join us to talk about.
Everyone. Or good afternoon, the case may be.
That's right, depending on where you are. John is joining us from Dallas today, so we're really excited about that. Thanks, John. Okay, as we can see, first off, let's get started here. You can see the state of the market. There's still definitely. Why are we doing this webinar? Because there's a lot of strength in the markets out there for Q&As. Especially, up to 2017, lots of VC-backed exits, and we're still seeing a lot of that going on here. I'm going to get to the 2018 here. You can see in 2018, deal sizes still remain elevated. We have been seeing deal flow here in 2018, and the valuations in our own client base that are being acquired are pretty high. John, are you seeing the same thing right now in your current workload?
I am, yeah. We've been very busy. There's a lot of transactions going on. So yeah, it's been a very market's still very hot, it seems.
Awesome. Okay, here. So the next slide. Yeah. So because of that, some deal count is down a little bit, but again, the valuations are high, which is making it a little bit more challenging. I think people want to get the highest value as always. So hopefully we can talk about that today with regards to what that looks like for Q&E. So quality of earnings, John. Why would you need one? Walk us through this. Why would someone need a quality of earnings report?
So there's a number of reasons to do it, and we'll talk about a lot of them this morning. But primarily, it's really most transactions are still driven by multiples of EBITDA. That's usually kind of one of the biggest factors in it. And what it really does is companies or buyer wants to know what a normalized EBITDA looks like. How is this company done historically? Obviously, it's backwards looking. It's not forward looking. But they want to understand the business, and that's what quality of earnings focuses on. It's very much a P&L focused activity and report. And the other piece it really kind of focuses on is working capital. We'll touch on that a little bit. But that's really what it's focused on, because at the end of the day, most buyers are buying the future operations of the company, but they want to understand what the company looks like. And it's different than an audit in some really kind of key ways. The first is, as I note here, a quality of earnings report is management driven, which is to say that the buyer really dictates what a quality of earnings report will focus on. Dean and I were talking yesterday in preparation for this, and one of the quality of earnings reports, not really a full quality of earnings report we're working on, but the buyer's only interested in looking at revenue of the target company. That's all they want us to look at. So, for an audit, you need to, as you all, I'm sure, are aware, You need to have, meet minimum standards to complete an audit and issue an opinion of work that needs to be done, activities that need to be followed through on as part of the audit. Not solely quality of earnings. We can do as much or as little work as the buyer and seller really agree on us to do. And that's kind of for the first big difference. The second difference, I guess, is really that it is, as I said, it's P&L focused. We're generally using management's information, although we are testing it to some degree. But we're not doing the kind of independent testing and verification that you do in an audit. So we're not issuing an opinion like you do in an audit. So there's no attestation, no independent opinion issued as a part of a quality of earnings. As I said, it's really focused on EBITDA, which is earnings before interest, depreciation, and amortization. And actually, it should be interest, taxes, depreciation, and amortization. Forgot the T there. I just realized. And the reason they use EBITDA is because it pretty much approximates cash flow, and it's kind of a shorthand for the cash from operations. That's really kind of what it does. And what we do then is we really normalize that. So we're looking at, we'll talk about what that means, but it's really kind of trying to normalize that for activities that the company's looking at. The other thing is, as we talked about, is working capital. A buyer is very focused on very often with working capital. It really is kind of the position of the company, how much cash the company has, and very much impacts how much cash the investor or the buyer is going to need to invest in the company going forward in the short run for daily operations. So working capital is the other kind of big focus of quality of earnings. So Dean, if you want to jump to the next slide, unless you have a question.
Yeah, I do have a question. So it really sounds like this is really a P&L focus type of a look versus, in a GAAP report, you have the balance sheet and, statement of cash flows and other things. Here, we're really looking at the P&L. Is that fair to say?
Yeah, it really is the focus. The focus is very much on the P&L.
Got it.
The balance sheet tends to be, other than working capital, tends to not get a lot of look at a quality of earnings report. Unless you have a company, if the company's heavy capital company, like a heavy manufacturer or something, might be different. But for most companies, no, the balance sheet typically is not really much of a focus on a quality of earnings report.
Got it. Okay.
Okay. So what kind of adjustment, we talk about normalizing EBITDA, what are we looking at? So the first thing is, clearly if there are corrections for GAAP, we would identify those. We usually start with an EBITDA as reported by the company, and then make various adjustments to it. And then Dean, why don't you click down a little bit? There's a few more here we can talk about them. Okay. As I said, the first is correction for GAAP. Typically, if the company's audited, it wouldn't be any. But a lot of times we're working with companies that have never been audited. So we will correct errors for GAAP to the extent we find them, and that's usually the first adjustment. But the bigger adjustments typically are the other things you see listed here. One-time expenses, one-time gains and losses, one-time gains or unusual items. And these are the things that they want to pull out. For GAAP financial statements, if you have big, let's say, legal expenses, gain or loss on a sale of assets, if you've hired a banker, perhaps to help sell the company or involved with the company in the transaction, those can be some fairly substantial expenses that'll show up in the P&L. And that's appropriate for GAAP. I mean, for GAAP purposes, those are absolutely correct. But for quality of earnings report, we generally want to adjust those out because the buyer or the investor wants to see what the company looks like kind of on a normal running basis. When we talk about normalized business expenses, this is an area where we tend to spend a fair amount of time. And what we're looking at here is very often a target company, particularly in the startup phase, we'll have expenses included. Not that they're wrong, but they aren't things that the buyer will necessarily carry forward. There could be extra employees that the company may not need going forward. Those could be anything from if the buyer is, may not need an accounting department in any operation they're buying, so those get adjusted out. You will have salaries. A lot of times, the founders of the business will have more salaries that are not at market. As I'm sure a lot of you are aware, if you're the founder of the business, a lot of times you're not taking any salary at all, or in which case we want to adjust that up. We will add back a more normalized salary for a CEO of the company or CFO of the company. Or sometimes they're taking, above market, and that may be very appropriate from a GAAP point of view, but from a normalized business point of view, we want to adjust those out. Likewise, a lot of times, there will be departments that things like maybe a marketing department or a sales department or even an accounting department that the target doesn't really have fully staffed out to the degree they should. So those are expenses we would add back to try and give the potential buyer investor a look at what the company might look like on a normalized run rate business. So those are kind of things we're really focused on when we're talking about adjusted EBITDA. Dean, does that all make sense?
Yeah, it does. It does. Really what they're trying to do is get a sense of what the P&L would look like for them once they acquire the company. Does that make sense?
Exactly. Yeah, that's exactly right. Yeah, they really want to understand not that the financial statements are wrong for GAAP, but what it would look like on a more normalized basis.
Great. And basically, at the end of the day, this is all to set up that value for what that looks like for them, right?
Right. That's exactly right. What does it look like for the buyer or the investor coming in? So what are we looking at? And click down here. There's a couple more items. Let's get them all on the screen.
Oh,
one too many. Okay. So the first thing we always look at, and this is almost always the biggest question a buyer or investor have, are trends in revenue. They really want to understand what the business looks like at the top line, because that's more often than not what they're really concerned about. And you look at things like, customer concentration, product concentration, geographic concentration. Does this business, generally speaking, the more diverse the customers and products, the better the target company is, because there's less risk. The more customers and products, the less risk you have that any one customer is going to throw the business out or derail a business if they lose the customer. Now, obviously, in a lot of startups, a lot of times the buyer is very focused on obtaining a particular customer or small customer set or a particular product set. But they want to know that too. They want to really know if they're really interested in a particular product or customer, how much of the business overall is tied to that customer or product. So that's very important information the buyer is usually very focused on. Likewise, geographic concentration is very important. Are the sales very much U.S. based, North America based? Or do they have a lot of operations in Europe, Asia, Africa, Middle East, somewhere else in the world that they want to understand what that is? Because as we all know, there's certain risks and benefits to having international operations or very geographically dispersed operations. And then, of course, seasonality. Is the business highly seasonal, or is the business growing very steadily and pretty straight? And the cost of revenue question really comes down to: is the cost of revenue appropriately tied to the cost of revenue appropriately tied to revenue? Is the gross margin consistent? Or is there anything unusual going on in the cost of revenue that they want to make sure they identify? Unusual costs that might be included in there that have to be adjusted. And is it a fully loaded cost of revenue? So that the company, again, the buyer wants to really understand what that top line looks like and what that gross margin looks like, because that's usually the biggest focus and biggest area of concern.
Got it.
If you want to jump to the next slide there.
So, John, this is really jumping through the details here, right? That makes a lot of sense. The details of the P&L versus a GAAP financial statement really just says, is everything properly stated, right? Which could be the case. Here, it's jumping through the details of all the different transactions and trying to really figure out what the P&L that they would be buying looks like.
That's right. That's right. Which is the key point where this is different than an audit. As you say, from an audit, the only question there is the total revenue properly stated? The audit's not generally concerned about these kinds of questions. And that's bringing us into a quality of earnings really to kind of help the buyer ferret out all of this information and really lay it out for them. So not just what the total revenue is, but how that revenue breaks down across customers and products and stuff. You're exactly right, Dean. That's really what we're focused on here. It's kind of digging into that level of detail that you don't see in the audit financial statements.
Makes a lot of sense. Okay.
Yeah. So some of the other, yep, you jumped one too far.
Oh, okay. Sorry.
No worries. So again, what else are we looking at? Appropriate matching. I've mentioned this a little bit. Appropriate matching of cost and revenue. Again, to make sure that it's they understand the trends. Operating expenses. One of the big questions there is always, do they have appropriate cutoffs? Or when you're looking at trends for quality of earnings report, and I should say that I didn't mention this before, but I should emphasize that typically we're doing these on either a quarterly or monthly basis. So unlike an audit, which is, unless it's a public company, they're going to be strictly in annual numbers, the quality of earnings reports are usually quarterly or monthly. So when you're getting much more detail in the trends in the individual periods. So the appropriate matching of costs and revenue and operating expenses in the appropriate period is something we were always looking at to help them make sure that they understand how the business is flowing. Do you have appropriate cutoffs in the various periods, and not just at year end? Again, are there any unusual operating expenses? I mentioned some of the things we looked at before, where you've got people being paid too much or too little compared to market. Are there any unusual expenses that are flowing through there? A lot of times, and you see more in unaudited. A lot of times, owners, founders will have a certain amount of personal expenses and things, and the operating expenses will pull those out as well. And then the unusual items that I've talked about that could be that we might want to adjust for. Again, it's about helping the buyer or investor really understand the flow of the business, kind of month in, month out, and so that they can really understand what it is they're buying.
Great.
On the next slide, this is really kind of the more the working capital side. Again, this is some of the big items we tend to look at, not an exhaustive list. But we're looking at accounts receivable. Are the accounts receivable really aged? What is the timing? What are the terms on which the business is not just necessarily stated terms, but what are the actual collection terms? Do they have appropriate reserves for their receivables if they need them, if they're aged? If you have a company that has inventory, that's always an area that gets a lot of focus. Do you have old inventory that's not being written off? What are the inventory turns at the individual product level? Again, it's really getting into that level of detail. It's really going to drive the business going forward. And then the liabilities, have they properly recognized all accruals and liabilities? Have they got everything on the balance sheet that they really should have on the balance sheet? Because these are the big items that really kind of drive, as I said, the buyer and investor coming in is always interested in what kind of funding do they need to provide the business, particularly in the short term. I mean, they can put long-term financing in place in terms of investors or long-term debt, bank debt, things like that. But a lot of times in the short run, a buyer's got to come in and put in working capital. If they need to do that, they want to know what that numbers look like as part of their planning and part of the purchase price negotiations. So if you want to jump ahead there, Dean. Okay. So we talk about quality of earnings reports. We talk about buy side and sell side. The buy side is mostly what I've really kind of been talking about in the way I've been talking about it. That's the buyer coming in and looking at a company they're interested in buying or an investor that they're looking to invest in. But a lot of the work we do is sell side due diligence, which is essentially, one of you on this webinar decided to have us come in and do a quality of earnings reports on your own business in anticipation of selling the business. and you might be wondering why you would do that. And there's a number of reasons to do it, and why a lot of companies will choose to do it. The first is that you really want to identify issues up front. You don't want to, as you get into negotiating with the seller and getting into closing the deal, you don't want things coming up at the last minute. You don't want surprises. Obviously, the seller doesn't either. The buyer doesn't either. But as a seller, you want to make sure those things are up front, and you want to understand them, what they are, because the buyer's going to come in and look at them anyway. So you want to make sure you understand them first. And it really gives greater confidence in the seller when the buyer has that. When a potential buyer investor comes in and you can hand them a quality of earnings report up front, the buyer immediately has more confidence in you understand your business, you understand the issues. And quite honestly, we tell the sellers all the time, if you know something is wrong, you want to get that out there on the quality of earnings report and put it out there. Things like, if you haven't properly been collecting and remitting sales taxes, if you've got, personal expenses running through the business, any of those kinds of issues, it's one of those things the buyer's going to find out anyway when they dig into it. So it's better if you just put it on the table up front, appropriately address it and deal with it. And it just really kind of makes the transaction go much more smoothly, because you don't want at the last minute for the buyer to come in and say, oh, by the way, we found the problem, because they're going to want to renegotiate the deal then. And you don't want that to happen as a seller.
And John, I think that's the $1 million question about all the things that, all the content and insight that you've given us in the past couple of slides. It all goes back down to purchase price. So if we're finding things that normalize, if we're finding these things that impact valuation, what kind of what can people expect when it with regards to adjustments and things of that nature?
So in my experience, the seller, if the item's material, obviously it could derail the deal. I mean, that does happen, although it doesn't happen very often, quite honestly. What the buyer will typically do, if there's a lot of adjustments, negative type adjustments, where the EBITDA ends up being much lower than they expected, they may want to negotiate the price. They may want to put some amount in escrow. They may want to turn some of it into an earnout if they're not sure how the results are going to be. And those are the more typical kind of results you see as a result of a quality of earnings report, where the buyer will, the overall price may come down, but more often than not, I think you see that either it's held in, some of the purchase price is held in escrow, or some of it's converted to earnouts. If the buyer has a little less confidence in what the deal looks like. Those are kind of how most buyers I've seen react to it, and that's why it's important from the sell side to kind of get those things on the table up front, because you don't want those coming up at the last minute. And quite honestly, you then can address it. Now I have to say that most buyers, when they're coming in, they expect some adjustments. I mean, particularly if you've never been audited, if you're looking to sell your business, it's never been audited, you're kind of in that startup mode. You don't have a very sophisticated accounting department, sophisticated CFO. The buyers are going to expect a certain amount of adjustment, and that's okay. They generally don't go crazy about it. It's just you don't want to have any really big negative surprises, because that's what can derail a deal at the last minute. Got it.
Okay, that's good insight.
In terms of kind of what is the QOV process? What does it look like? We start with the management financial statements, which tend to be much more detailed, as I'm sure you're all well aware. Your audited financial statements tend to be fairly high level, but underneath that is typically the management financial statements, which have a lot more detail, and that's where we start. And we always start with management, basically determine management reported, management determined EBITDA, and then we work from there. You would expect to get we would come in and give a PBC list, prepared by client list, which is very similar to if you've ever been audited. You're very familiar with those. It's a list of requested documentation that we want. And it's kind of a lot of the same kind of information you're gonna request for an audit, account reconciliations, things like that. But it's going to be much more operational focused. As you've seen the things we're looking at, it's heavily focused on customers, customer concentration, who the customers are, a lot more inventory detail, a lot more into the trend analysis, monthly or quarterly trends of the financial statements than you're going to see with an audit. Again, because it's that much more operational focus. Often the timeline is very compressed, particularly on a buyer, because a buyer is going to come in and they're going to want to complete this process in kind of 4 or 5 weeks, typically at most. So it's going to be a very compressed timeline. So it's going to be, kind of a lot of work and sometimes be a lot of hours in a fairly short amount of time to kind of pull all this information together and make sure we understand it.
Awesome. Okay.
Which is another reason, by the way, if you're thinking about selling your business, to have this done up front, because you'll get a lot of that information ready. So when the buyer comes in, you have that readily available if they want to go on and do their own Q of E.
That sounds really good. So would you say a Q of E is normally done then, John? It sounds like even if you have audited financial statements, a Q of E is a good thing to do in addition, especially if you are a privately held company. Closely held company, I should say.
Yeah, they're almost always done to some degree. Because an audit provides a lot of good information. Don't get me wrong. I know, Dean, you're a former auditor, so a lot of great information in the audit, but it just doesn't have enough detail. Really, typically, what the buyer really wants to make sure they understand. They want a much more detail by month or by quarter, and as we've seen and things we've talked about, a lot more detail around customers and level of expenses and trends, things like that, they aren't subject to the audit. The audit's typically an annual look at the numbers. The numbers are right for the year, but it doesn't kind of tell you what's going on in each of those 12 months.
Great. This is good insight, John. Thank you so much.
I think there's one more slide.
Yep.
Yeah. What should you do to prepare if you're looking to sell a business? A lot of it's like preparing for an audit, as I said. Make sure your account reconciliations are all up to date. You understand your business. You really want to focus on quarterly numbers, if not monthly. A lot of small businesses tend to just kind of close the books once a year. But you really want to kind of go back and try and clean up those quarterly numbers and make sure you've got at least your quarters cleanly stated. Because that's what the quality of earnings report is going to look like. We're going to look at, and it's going to be a lot more painful process if you're trying to do it at the last minute. And the other thing is really understand your business. It's a lot of the quality of earnings reports we come in, and it becomes, as we're trying to do this, you want to make sure you understand as a seller of the business, who your key customers are, where the concentrations are, what are the trends and variances in the business. If you're doing a budget versus actual analysis, if you're not doing a budget versus actual analysis, you probably want to start doing that because it really helps you understand the business. Because the buyer, that's what they're going to want to know. They're going to want to be able to dig in and really kind of understand all that information. And you as the seller, you want to make sure you really understand and have that information readily available. So if you're thinking about selling the business, you want to start now to really start understanding that and tracking that information so that you're ready.
Awesome.
I think that's...
And we're right there at the end of it. Unfortunately, John, we're right at the end of it. We won't have time for questions. So what we will do is, thanks for everybody who left a question. We will circle back with you. We do hope to see everyone next month for the completeness of tax accruals. We know that tax accruals are going to be a big piece. They are a big piece of an M&A activity currently. And we're going to dive into that a little bit more next month. We hope to see you guys tune in then, and we'll follow up with everyone on their questions after this. So thanks so much, everyone.
Okay. Thanks, everyone.